So part of today is to just talk a little bit about the context of the new regulations and to perhaps take a slightly more measured view. And my message today is don't panic. This is a step change for the profession, but it's incredibly manageable, and I think we'll come down to a few simple, straightforward ideas that you'll be able to take away today, I hope, to feel more confident in your compliance. A little bit of background then. It is worth noting some of this. First of all, a bit of the law is important. The background is that this actually came in essentially through an EU directive in May 2015. And time flies very quickly. Little did we know back then, I think David Cameron was quite confidently carrying on in Europe. Little did we know what would happen a couple of years later with our own general election, which forced quite a quick process through Parliament with our own interpretation of the law. So the fourth Money Laundering Directive is an EU piece of legislation, May 2015. All member states, all 28 member states, soon to be 27, are obliged to transpose the law, so they take the EU guidance and interpret it into their own country's law, in our case the UK, by the 26th of June 2017. Incidentally, and in brackets, we're hearing a few countries in the EU that haven't yet transposed it, which is unusual to say the least. But nonetheless, the UK has managed to do it slightly by the skin of our teeth. We're in a state where at the moment the law was passed as of the 26th of June, so we hit our deadline. Parliament was dissolved for a few weeks early in June, in those heady days of June, and there was a question mark whether or not we would get there, but we did indeed get there. So there is a process that was truncated. Normally you have 21 days to lay a piece of legislation before Parliament and debate it in the House. That didn't happen here. There was a special procedure, and it became law on the 26th of June. Now, does that mean, you're scratching your heads, I'm sure wondering, does that mean that we need to be fully compliant as of the 27th of June? In a nutshell, yes, but. HMRC says, of course it's law, but we do recognise, and I think slightly under their breath, they recognise that this was a very quick process as well. But helpfully, they've said to us that they will adopt a pragmatic approach for those endeavouring to comply. And what I think all that means, and what we're advising clients is, you can't just press a button on the 27th of June and expect to be fully compliant with some quite big changes that we're going to go through at the moment. The thing to do is to sit down with a bit of paper and with what you currently do and our guidance, and think about how do we get there most quickly, and target the biggest risks that you think you're going to face and attack those first. There is no formal transition period, therefore, but as I say, we've heard from HMRC and we're advising our own clients as well that there is an informal transitional period, essentially. And I think as long as you're sitting down and planning how you're going to comply and you have a proper project, and it is a project, then I think that if you aim to be fully up and running by sometime early autumn, September, mid-September, I think that it would be very hard to criticise you as long as you're attacking it now. So that's my message to everyone in this room and beyond. Before I attack the new differences, just a couple more words, if I may, on what's been brewing. Globally, as the world gets smaller, if you like, from a commercial perspective, the ways in which money is moved around, money is held through complicated structures, trusts, SPVs, in jurisdictions perhaps where it's quicker and easier, perhaps where there's more secrecy. That is viewed increasingly by the global economic community, particularly after 2008, as something that should be taken with a sideways view and perhaps some suspicion, rightly or wrongly. And what's been happening globally, and the fourth AML directive is very much a part of this, is a way in which the world should have fewer darker corners in which you can hide your money if you're up to no good. And this new legislation is all about people up to no good. It's quite simply about eking out situations, making sure that criminals cannot easily find those dark corners of the globe to hide their money, either through using trusts when they shouldn't be doing so, putting up a nominee that's a patsy. Let's take an 18-year-old, as I saw quite recently, buying an £8 million prime flat in London in a new development with no history, no background, nothing, through a BVI company in that case. we're expected to now ask questions in those circumstances. It sounds obvious, but actually many people don't. And this is what this legislation is all about. Pointing out when those suspicious circumstances arise and kicking the tyres, really testing it. And it's no more than that. Let's have a quick look then at the key differences between what happened, what was the state of the law before 26 June this year and where it is now. And we're going to be running through these in a bit more detail. So domestic PEPs, I hope everyone knows what a PEP is, and it's okay if you don't, a politically exposed person. Think cash for questions, that kind of person, someone who is in a position of influence in a political system. We're now looking at domestic PEPs. Beneficial owners register we will talk about in slightly more detail shortly. Again, it's about showing who's really behind the structure. We're now required to have a register, and every country is in the EU and beyond. Parent undertakings for those that have international businesses. In certain circumstances, you'll be asked to apply UK law to your local office. And we'll talk about that. That's quite a big departure. How can you compel your office in the Philippines to carry out UK law? Fourth Money Laundering Directive has something to say about that. Simple stuff, appoint an MLRO. I'm an MLRO. I'm the one that, I say this jokingly, but it becomes less funny. I'm the one that goes to prison if we don't plan things properly, if we don't understand this legislation and report upwards where we see something suspicious. So appoint an MLRO. If you're an estate agent, under the Estate Agency Act, you're caught by the regulations. If you're carrying out a estate agency business, you're required to register and appoint an MLRO. Failure to do so is a criminal offence. I told you it'd be a nice light talk today. Customer due diligence. We'll talk about that because there's been quite a big change there, and timing is really important. There have been some changes to the kind of due diligence we're allowed to do. There's been some tightening up there, and we'll talk about how you can attack that practically, what it really means now, as opposed to just before the new law. Reliance, I think, will be an increasingly important thing for those that already use Reliance. You'll be familiar with it, but we'll talk about that a bit more. And also, and this is in no particular order, risk assessments and what they really mean today, and do we need to do them. So hopefully that makes sense so far, and let's delve a bit more into detail. Now, domestic PEPs is one big change that's happened. As I say, PEPs are people who wield influence, and many times we will be looking at clients that have properties, investments, structures, where wealthy individuals from countries outside of the UK want to invest in the UK. Now that's fine, we want that inward investment, we want the economy to grow, but we want to do it in a legitimate way. In the past, we were only concerned with foreign PEPs. PEPs are seen as potentially suspicious. Just because someone's a PEP does not mean they should be penalised. You can't buy a property because you're an MP in the UK. That would be ridiculous. It's just recognising that from a corruption perspective, someone who wields influence in government potentially is vulnerable to bribes and all the rest of it. So we watch out for that. And in the past, we were only concerned with foreign PEPs. So if you've got let's take Russia, for example, someone high up in the Russian government or married to someone high up in the Russian government wants to buy a high-end property here in the UK, you'd have to identify that in the past, take steps to identify that person, and then get senior management sign-off once you've investigated a bit further. Well, that now applies to domestic PEPs. It's ironic that we're in Whitehall, so anyone in Whitehall, they all have flats, I think, for renting and all the rest of it. We'll have to consider them a bit more deeply. Domestic and foreign PEPs. You'll have to carry out enhanced due diligence, and if anyone's got questions about that, do feel free to answer now, but perhaps better at the end. Enhanced due diligence, as you can see there, is required once you've considered your risk management systems and procedures, and you have to identify a politically exposed person or a family member, and then carry out enhanced due diligence. Now, what does that mean? I referred to kicking the tyres a bit earlier. In practice, what that means is standing back and thinking about what's this person really doing? Why are they investing? Does it make sense that they have the money from legitimate means to be able to do what they're doing, to buy that property, to make that large investment in the property sector? And if it does, and you take some steps to verify that, perhaps bank statements, references from a recognised professional like an auditor in a low-risk country, and I'll tell you how you can get a list of a low-risk country, and you get comfortable that that makes sense, then that's what you need to do. So it's taking that extra step just to see if it all stacks up. Now that can be quite tricky sometimes, as people know, trying to understand, in fact, where the money is coming from. In fact, sometimes it's quite embarrassing to go back to your investor clients 3, 4, 5 times with a drip of information. I'm afraid there's not a lot of sympathy for that from the directive's point of view, and we can give you some guidance about how you might do that early on. But be aware that you do need to carry out those searches. So domestic PEPs as well as foreign PEPs now, you need to identify them, you need to go a bit deeper and understand how they're funding their transaction and why. I mentioned before appointing an MLRO, and I said tritely that it's important that you do that. Well, it is absolutely law for those that are regulated, as you all will be, in the estate agency sector, and surveying professionals as well that carry out estate agency business. We recommend that you also register an MLRO. What you can't do is say that we only do 1% estate agency business, 99% surveying and valuing, and therefore we're not caught, or we're only caught for that 1%. You're caught for the whole piece. So just be aware of that and tailor your policies accordingly. You have to appoint someone. It's very easily done. It's cheap. It's free. It's quick. You just register with HMRC. A word to the wise: if you have a 19-year-old who's great at photocopying, they will not be an appropriate person to be your MLRO. Or your deputy MLRO. It needs to be someone of senior management ability. I am an MLRO myself, and I know that first of all you get involved in some really interesting discussions with people that want to push on and do the business, and actually they're under time pressure for good reasons. They want to do the business, and they don't want someone like me saying, well, hang on, have you got all the bank statements in place? It's important that someone's got enough gravitas, is difficult enough to ask those questions that they need to ask. So get someone who's credible in your business, who isn't going to feel under undue pressure, because the MLRO carries a particular responsibility. So get someone who's feasible. The other thing I'd advise as well is, particularly in larger offices or where you have multi-offices, let's say a chain of agencies around the country or abroad, think about appointing some deputies. I myself have appointed 3 deputies. We're a top 100 law firm. We're not the biggest, but we're certainly not the smallest, but we have 3 offices, and therefore I've taken the view that I can't manage it all myself centrally without having systems and controls. And one interesting system is to have specially designated deputy money laundering officers who can be my eyes and ears, and someone who can pick up on suspicion. So take it seriously, but do appoint them, because it's important that you do. Moving on to perhaps one of the more challenging aspects of the new regulations, counterparty customer due diligence. This, I think, is challenging for our sector. For those that don't know about this, up until the new regulations, and this, by the way, is a special treat for estate agents. None of the other sectors, casinos, lawyers, auditors, investment managers, trust services providers, I've probably left one out there, high-value dealers, none of those have to do what you now have to do in the estate agency sector, which is to carry out due diligence on the other party of a transaction. That's simply what it is. So you have to essentially treat not only your own customer as someone that you're forming what's called a business relationship with, but you also actually have to treat the counterparty, the other side. If you're acting for the buyer, you have to treat the seller essentially as your client. And that conceptually is quite difficult. How can I possibly know my client if it's not my client? And how do I approach that? And that is difficult, but there are some things that we can use and some approaches we can take to be more forensic about how you approach it and make it much more manageable. So that's the first point to note. You accept the seller as your client. Now, at what point do you do this? I think timing is going to be very important, and that's something that people have been wrestling with. I should just pause there to say that there is guidance at the moment, albeit in interim form, from HMRC, and I'll show you on the next slide a link to that. Do read it and digest it. Although it's only an interim form, it has evolved. There have been discussions between the profession and HMRC, and I think the guidance is reflecting that. And we'll talk about timing in a minute. But the first point to note is you form a business relationship, it's called, with both the buyer and the seller. In terms of timing, it's formed with the other party at the time of formal acceptance of the offer. Now, this guidance has evolved slightly. If you look deeper into the guidance, what that actually means is, if you think it's manageable, you can wait until you've got a really serious buyer, in the case of a buyer, someone who's got the money, their offer's been accepted, formally or informally, and it's moving ahead, and you're getting the feeling that this is actually really going to happen. In the case of residential, you might wait until the memorandum of sale has been prepared, agreed and signed before carrying out due diligence on everyone that walks through your door. In the case, and similarly in the case of commercials, you might wait until heads of terms have been signed, lawyers are engaged, people are actually spending proper money on this and it's going ahead. So you're not obliged, you won't be forming a business relationship earlier than that. So when people walk through the door, you don't have to immediately start carrying out due diligence on them, only when it gets serious, and only I say at the point of exchange of some sort of formal contract in the way that I've indicated. Something else to note, which I think is more subtle, a business relationship with your own client, I would say, is only formed when the contract that you have with your client or the contract for sale becomes unconditional. Quite often there are condition precedents, for example, which mean that until those things are satisfied, the contract doesn't become unconditional. It means they haven't entered into binding legal relations, and I think you can wait there as well, and that may be important. If you've got 14 days, 21 days to hang on, hold fire. Hold fire until you carry out that due diligence. Now, I did say there'll be a lot of buts and ifs today, and there is something slightly in brackets, but do think about with your own experience whether that's going to leave you slightly in the lurch. If you wait until the day before and it's a very complex structure, let's say several trusts involved, businesses, SPVs that are registered in overseas jurisdictions, not unusual and nothing odd in that, and not necessarily suspicious in our industry, you might want to just send out those questions a little bit earlier than the night before because it's going to take a bit more time. But subject to that, and that's entirely at your discretion, hang on until those conditions become unconditional. And I think that will help you when you address this practically. A couple more points, but just pausing there for a second. What do you do with all this, what we've just said? And I think what you have to do is write this down. It's very simple. Doesn't have to be in a particular format, but have a policy that you've thought about and write it down and document that. And it doesn't matter how you run your own businesses, as long as it's written down and understood by you and looks like some good governance, a good policy, then that's fine. Don't keep it in your head. Agree this with the MLRO and share that with everyone else and change your systems. It's that, if I'm being pessimistic for a moment, that should HMRC come calling or an outside agency, it's that you're going to point to and say, well, here's our policy, this is how we thought about it, and this is us executing it. And I think that's very important as well. As well as complying, we want to make sure that we're protective to some degree. Auctioneers, for those that are involved in auctions, I don't think that anyone in this room that I know is particularly involved, but there are many that are involved and some very big players that are involved. It says here you have to ID them before the paddle. It's a slight caveat there, so when you give them the paddle, if you've got 300 people coming to bid, you will have to, in theory, carry out due diligence, but only if you charge them a fee. If you're not charging them a fee, there'll be no business relationship formed. Is it worth charging a fee? Probably is. So that's an important point to note with auctions. The other thing is you don't have to complete, in our view, all the enhanced due diligence on a buyer who's bidding on an auction. Think about identifying them, verifying them. You absolutely have to take those steps. But the third crucial step, which is the kicking the tyres, the enhanced due diligence, that can be completed afterwards in the run-up to finalising the contract for sale. So you might exchange on the day the hammer falls, you carry out identification, verification on a risk basis, and then you reserve the right to go much deeper, and you will go much deeper for those next few days. And that's how we see auctions working, and that's how we're advising our clients. I'm going to move on from that. No doubt there'll be some questions afterwards. Very happy to answer those, but that's an important difference, but I think very manageable, although challenging, very manageable for all of you. Simplified due diligence has also changed, and if we just stop for a second, simplified due diligence is there because there are certain situations, customers, that are seen as and are particularly low risk from a money laundering perspective. Just pausing for a moment, if we think about what we have to essentially do to have a good money laundering process and program, we have to take 3 steps I mentioned. ID your client. I'm looking at you, Luai, unfortunately, just because you're right in front of me. So I need to ID Luai. I need to verify that it is indeed him. We've had cases where people have tried fake passports An MLRO from a very big accountancy firm came to talk to me recently and asked me who I bank with, and I said Lloyds. I said, you won't find very much in there, sadly, but I bank with Lloyds, with my wife, and she knocked up, I promise you, a really convincing bank statement for me and ID just using a website incredibly quickly as I was sitting there, and it looked exactly like my bank statement, and people are accepting that. So identify someone, verify that by checking that perhaps that's certified it really is Luai. But Luai may be, I'm sorry to use as an example, the person in front of you or that you've identified and verified is really them may still be up to no good. So we have to take that extra step by checking that they're not up to no good, and that's kicking the tires as I described, or enhanced DD. Asking yourself, does this really stack up? However, in those very low risk circumstances, let's just say, I always use the example of Richard Branson because we all know him, he's a pretty well known individual. We know his financial circumstances probably enable him, in the example I gave earlier of the £8 million flat without finance, with the 18-year-old, and that's a true story. Richard Branson would be slightly different. I and his Virgin Group, I believe that he would have the funds to buy a flat without having to borrow. He may decide to for good reasons, but he's probably got the cash, probably within his profile that he'd want a flat somewhere near his head office. That all makes sense. If I'm acting for Virgin, there's a prescribed list of entities, including those regulated like Virgin will be on a very large stock exchange with reporting obligations, where I don't need to go any further in terms of verification or identification. So you can just go on and onboard your client without asking any more. Perhaps just print something off their website, stick it on the file, and off you go. And as long as there's nothing else that's causing you to become suspicious, nothing else out of the ordinary, you can carry on. Now things have changed slightly. Simplified due diligence doesn't just apply on a prescribed list anymore. To get to that list, you first of all have to ask yourself positively and in your systems, am I suspicious? Is it justified to apply simplified due diligence? And that's going to be harder. So if I'm acting for Virgin and I see that they are indeed Virgin, I believe that this person does work for Richard Branson, it really is a genuine person and it all makes sense, I still can't automatically apply due diligence. However, what we are allowed to do, if you see in 37.2, is consider the extent to which you carry out basic due diligence on those kinds of companies. So if it's Virgin and I act for them in a commercial transaction, and I have done for years, it's the same people doing the same things that they've always done for years successfully. Do I need to change things massively? No, I don't think you do straight away. We're allowed to think about the extent of the timing of due diligence we're going to do and the type of measures we're going to undertake when carrying out simplified DD. So I think you have to be much more careful rather than looking at old days last June, rather than looking at a list and saying you qualify and I'm not worried about anything else. Now you have to take those positive steps to ensure that it is absolutely justified to carry out enhanced due diligence, but you can decide the extent you're going to do it. And I'd say maybe in that case go and check in with them. Go and see them. If you haven't seen them for a couple of years, go and see them, have a chat with them, understand their financial position a little bit more, what's going on corporately, and then move on with your business. So I think that's important to do. So do a bit more when it comes to simplified DD than we're used to. I talked about practical steps, and that moves me quite neatly onto reliance. Now reliance, I think, is an underutilised and slightly terrifying for all of us process. What reliance allows me to do as a regulated entity, just like you are, is say to the client that I'm acting for, if they've just been onboarded, as we call it, by another law firm or an estate agency 2 weeks ago because of the same transaction, do I really have to put that client through the pain of coming to see me, nice as I think I am, coming to see us, having to bring their passport, utility bills, and asking them all those good questions, and then electronically verify them? Well, sometimes it makes sense, doesn't it? You've just been onboarded by, PricewaterhouseCoopers the day before. Can't I just ask them? Have you checked them out? Are you satisfied? And if so, can't I just rely on what they've done? And that's what reliance is all about. Now, it's underutilised because professionals are typically quite risk adverse. But I think all of us in this chain, in the property sector, are going to have to comply with each other much more if we're going to really make this a slick process. And full FAME LD is there for an important reason. It's there to protect our financial sector from corruption. And I think if we work slightly more closer together with things like Reliance as an industry and as a sector involved in the chain of a property transaction, by using Reliance as a good example, things will be much quicker. What do I mean by that? Rather than a bank down the road saying, well, no, you can't rely on any of our stuff, or another estate agent saying that, if you feel confident that estate agent A has good systems and controls, then absolutely why not say to them, are you happy you've carried out those checks? Have you identified them and verified them? And if they say yes, then you don't have to do that step again. Why should you have to do that? You still have to think about whether there's anything suspicious going on. It's not a reason to abrogate your responsibilities. You don't have to stop thinking. You can't stop thinking. And you're still ultimately responsible for your relationship with that client if they're up to no good. But you can, those basic first two steps, ID, verification, you absolutely can rely on someone else. And I think that's going to be increasingly important with the slide we just showed, due diligence on the counterparty. Because as I said before, how can I know my own client when they're someone else's client, but I'm expected to? Well, intelligent use of Reliance will enable you to at least take those first two steps of identification and verification if you're confident to do so. And I'm already seeing, and we're already seeing in our firm, an increased wish and interest in Reliance in our sector because of the slide I just showed, and that's evolving already. So people, I think, are already on this, they already have it in mind. So expect as professionals, lawyers included, far more requests for Reliance and an expectation from agents that you're going to actually allow them to rely. There's a few practical changes in relation to Reliance, but I do think that's going to be a big driver for you all. And don't be afraid of Reliance. I would say if the circumstances feel right, you trust the person you're relying on, and you're still thinking about what's really happening, then I would say feel confident to apply Reliance much more frequently. A couple of quick things. Look at FATF, for Financial Action Task Force. Think about the country in which that person is based. If I'm going to rely on an auditor based in, let's say, Pakistan, which is considered to be a high risk from a corruption and money laundering perspective, according to FATF, that's an internationally recognised standard, then it's probably not reasonable for me to rely on it very confidently that they've done everything they need to do to ID that person. However, if it's in a much more recognised jurisdiction, let's say Germany, or indeed the UK, or anyone in the EEA, of which there's an easily available list, or indeed other countries that Transparency International, for example, think are low risk or medium risk or that you're aware enough of which countries are seen as a higher risk, which ones are seen as a lower risk, and focus on the lower risk ones. Other than that, very useful. You'll need to have a written agreement with the party that you're relying on. And that includes audit rights, and that they'll keep the documentation for the specified period. And that specified period is 5 years from when the business relationship ends or the particular transaction is finished, so 5 years. So as long as you've got that, and that means, of course, because we're still responsible, we can call on those documents whenever we need them. Let's have a look at the passport. Let's see what you really did. Other than that, though, feel confident with Reliance is my message to you. For those that have international practices, or perhaps with topcos, holding companies, with subsidiaries doing estate agency work, for example, globally, or having perhaps a chain of different businesses, for those that have a parent undertaking, you'll see Regulation 20 here asks us to ensure that you have policies, I'm going to read this for once, policies, controls and procedures referred to, money laundering controls in other words, to all of your subsidiary undertakings, including subsidiary undertakings located outside of the UK and to any branches outside of the UK. And this is crucial, which is carrying out any activity in respect of which the relevant person is subject to these regulations. What does that all mean? If you're a parent, if you're structured and you have a parent company that's carrying out regulated business, so an estate agency is your topco, but you have overseas offices, as I mentioned slightly earlier, or branches, you can't just stand back and allow them to carry on business according to local customs and controls only. You will have to ask them to do what you're doing here in the UK, to bring their, I hate to use the word up, but to bring their standards to a point where they're consistent with what you're doing in the UK, which is viewed as a bit of a leader in terms of good money laundering controls and systems, rightly or wrongly. So let's take the example of having an office in Thailand, your local office, no connection with your UK business at all, apart from the fact that they're in your network, UK business, Thai business, doing a commercial deal with a local Thai developer, doesn't touch the UK at all. Through this regulation, the UK's jurisdiction will now extend out to Thailand. Essentially, you'll be required to roll out your policies and procedures in that country. I'm advocating that you have to think carefully about how you're structured, because the legislation talks about a relevant person. A relevant person is someone who's caught under the Money Laundering Regulation. So think carefully about how you are structured. Just because you have a topco, if it's just sitting there doing nothing, doesn't do any business, it's not necessarily the case that this regulation kicks in. You should be carrying out regulated business. I mentioned a link. This will all be available later, by the way, on the website in due course, I think. But no otherwise that the interim guidance that's available, that is evolving, which is good news for us. It's quite clear. It's about 50 sizzling pages of money laundering, but it is actually very readable and I think very helpful guidance. And I do recommend that everyone reads it and considers it. It's available, so just do click that link. It's a free resource and it's actually very helpful guidance indeed. Now that we're up to the last slide, I wanted to mention some practical steps. In no particular order, but I'll just run through these. Absolutely train your staff appropriately on all of this stuff. Do let them know that there is this interim guidance available from HMRC. That's important that we meet that guidance and that they understand why these rules are here. If you're reviewing all your systems and controls, which many of our clients are, please make sure that you've underlined to them why you're doing it and train them on your changes. They're the people, they're your front line. They're your first line of defence, if you like, in making sure that we don't have any leaks in our money laundering processes. We're formally required to carry out a risk review. That is in the regulations. It's an important step because unless you understand the risks to your business, it's very difficult to make sure that you plan to cover over those risks and put your resources in the riskiest areas. So again, I mentioned, if 1% of your business is a state agency, then you might want to cut your cloth accordingly. Or you might look at that 1% and say, sure, but all of those are just acting for 3 institutional businesses like Virgin. So it's a relatively low risk, and plan your systems accordingly. There's no point having a fantastic system that picks up overseas subsidiaries if you haven't got any. That sounds obvious, but do think about planning for what you actually do as a business. Write it down and review it, and that we say should be reviewed every 2 years is our recommendation. It's a formal requirement to carry out a risk review. There are templates available and we'd certainly be happy to advise anyone on that. I've mentioned the 3 W's in the slide here, just because I think it's handy, but in terms of, I've talked about kicking the tyres, does it stack up, does it make sense? I also advocate the 3 W's, which is think about why you're being asked to do something, who you're being asked to do it for, who's really behind this, and what are you really being asked to do? If you're being asked to flip a property at great profit, or a sub-sell as they used to be called on the same day, that might be okay, but it's generally thought of as potentially a suspicious red flag. So think about who we're acting for and why we're being asked to do what we're doing. Why are they coming to you? I'm sure it's because you're brilliant, but do think about why are they coming to us? Is it because we're perceived to be vulnerable in some way? It's a difficult thought, but just think about, does it make sense that someone's using my firm for this particular transaction? It probably does, but do think about it. Review your customer base. This follows on from the risk review. When you are thinking about your risks, what do we do? What kind of customers do we have? Where do they live? How do they structure themselves? What are they doing? And evolve your policies accordingly. I've mentioned an MLRO, so I won't talk about that again. Register with HMRC, it's incredibly important, and again, that being flippant, I do think the HMRC interim guidance is incredibly valuable. It's a great resource, so do read it and understand it. The National Crime Agency is mentioned there. One way of reporting suspicions is to do it online with the NCA, the National Crime Agency. It's again, cheap, quick, easy to do. It's free to do, so register with the NCA if you're an MLRO, if you do need to report a suspicion. And just on that, I think you should be not reporting suspicions for the sake of it, but think about whether you've reported a suspicion, a transaction, if you filed a suspicious activity report in the last 12 months, and if not, really think about why. Because it might be slightly odd that you haven't. And as a profession, the estate agency sector really lags sadly behind all of the suspicious activity reports that are filed. it doesn't mean fire one off just for the sake of it. This is about providing good intelligence to the criminal agency so that they can then investigate something that really is suspicious. Don't just fire it off, think about what you're doing. But if you have a suspicion, and train your staff about what is suspicious, I have a list which I'm very happy to share with you. It's just on one laminated sheet. And this is what I think is suspicious, and I give it to all the staff. Make sure they've got it on their desks so that they're familiar with these red flags. It's really important. That's what it's about. Spotting suspicious transactions and telling those that are in a position that have powers to carry out enforcement. And that's really what this is about, and protecting our the integrity of our systems. I mentioned a transitional period. You don't just press a button and expect it all to be ready in terms of fourth AMLD. Have a good plan and really be active about getting compliant with fourth Money Laundering Directive. Really important. This informal transition period won't last forever. I won't talk about all of these. Talk to your peers. It's great that people have turned up today because we can share good practice. And I found our sector to be incredibly engaged with the new regulations, and that speaks very highly of your profession, of this sector, and your regulator. People are really concerned to make sure that we have great systems and controls but can still deliver great service, because this is all about running a business ultimately. But you want to do it in a compliant way that you're proud of. So talk to your peers, and you'll find you're surprised that they will want to help. Again, labouring the point, think about the risks to your business. That's most important, document that. And I've said here at the end, slightly flippantly, watch this space. I say watch this space because best practice is evolving. People are sharing that. The interim guidance will become finalised. There may be more to come on that. So just be really engaged with the changes that are out there.